Hello friends, Shaifaly Girdharwal this side and you're watching Consultees. In this video, we will discuss the latest update related to the indirect taxes all over the world. So the 6 GCC countries have decided to introduce the VAT or GST in their countries. So it's a unanimous decision of all 6 countries belong to the GCC corporation. These 6 countries contain the various countries like UAE and Saudi Arabia. So these countries will also introduce the GST or VAT. Why I'm saying GST or VAT? Because GST is nothing else but it is also a value-added tax. So in some of the countries it is called GST, and in some of the countries this is called as VAT, that is VAT. So from 1st January 2018, the VAT or GST, a simplified VAT, will be applicable to all 6 GCC countries. So this is a very important news update. Then what will be the impact on those countries for this particular thing? Because earlier all of these countries were basically dependent on oil for their revenues, but now they will have another source to develop their countries. And how it will impact on businesses in India, the structure of GST, I can say it's very complex. It's extremely complex if I compare it with the other countries, because India have a dual kind of structure. It's a federal country. There are the center and there are states, and both have their own power, their own area of work, their own capabilities. So powers are distributed between the states and the center, that make the structure of Indian GST very complex. The provisions are like very complex. There are so many sections, there are so many rules, there are so many provisions. But in the Gulf countries, I can say the provisions of VAT will be very simple. The expected rate will be around 5%, and the structure will be very simplified. Just like in India, GST in India, there will be some exemptions for some specific people, for some specific industries, and then there will be a kind of threshold limit. So the people working below that particular threshold limit will not be liable to take registration or to pay the taxes. In indirect taxes, because in those countries people are not very much aware about the structure of an indirect tax. So in the indirect taxes, the basic difference between a direct tax and an indirect tax is, in an indirect tax, the tax is payable by some other person, and that person is not same with the person who will bear the final burden of that particular tax. So that's why every indirect tax have a levy section, that is a levy which is created on a person, on a business person, or on an industry, or whatever kind of activity, which is the taxable event for the particular tax. So in GST or VAT, it's a consumption based tax. So the suppliers will be liable to take registration because the levy will be generated on those people. So businesses will be required to take registration. Then they will collect the tax on behalf of the government, and then the tax will be deposited to the government, and they will also be liable to file the return so that they can give the account that how much tax they have collected. So this will be the basic provision. With the series about the VAT or GST in the GCC countries, we will also come up with the latest videos, the new videos with the latest updates related to the VAT in these countries. And I think because in India we have the most complex structure of GST, so we will be able to help those people, those consultants, those business person located in these countries very well, because we are already well versed with a very complex thing. So it will be a little easy for us to understand that in a comparatively very simple taxation scheme in those countries. So with this, I am closing this video. Thank you so much for watching this video.